Hello and welcome to the 7th meeting of our virtual seminar series on central banking and digital currencies. Today's host is the Riksbank, and I will now turn things over to our moderator today, David Vestin.
Thank you. So today we're really happy to have Andy Levin here to present the paper, Golden Papers and the Paper Fetters. It's a joint paper with Michael Bordo and Arunima Shina. Andy will present, and he really doesn't need much of an introduction, but for the sake of it, he's a student of John Taylor. He has numerous publications in monetary economics, primarily. And on top of as you all know, having a very successful academic career, he has also been extremely successful in the policy circles with a long-standing career at the Federal Reserve. So it would be really interesting to hear Andy's perspective on these issues. And he will have 25 minutes to present. Then there will be a discussion by Todd Keister, and he will have 10 minutes to discuss this paper. Todd is professor at Rutgers, and we're really happy to have this constellation going. So with that said, Andy, the floor is yours, 25 minutes.
Well, thank you so much. It's really great honor for me to be able to speak to all of you and present this really new work with Michael Bordo and Arunima Sinha. Both of them, fortunately, are here, and they're going to be active in the Q&A. But before I dive in, I just also wanted to reach out and say a shout out to Gaudi Egertsen, who was originally going to be the discussant today. He's an extraordinary, remarkable scholar, as many of you know, with just amazing combination of familiarity with monetary history and with DSGE modeling and with policy. So we'll look forward to having Gaudi hopefully get his comments sometime down the road. Wish him well. But we also really appreciate Todd filling in on short notice as a discussant today. So with that, why don't I go ahead and dive in here? So I'm going to share my screen, and hopefully this will go smoothly. Okay, so as I mentioned, this is joint work with Mike Bordo and Arunima Sinha, and just read the red ink at the bottom that these are just our own views. So there's a lot of history about the gold standard. Mike is really an expert on this. He's worked on it since, I think, for maybe 50 years or something, maybe more than that. What's interesting about the gold standard is that during the time the gold standard was in effect, a lot of distinguished scholars noted its shortcomings year after year, decade after decade. And these are names that would be familiar to many of you: Jevons and Marshall and Bixell, Irving Fisher, who not only pointed out the shortcomings, but also recommended improvements to provide a more elastic currency that would provide more systematic price stability of the general price level. The distributional effects of the gold standard were also a heated issue year after year, decade after decade, the most famous being William Jennings Bryan, who was a US presidential candidate in 1896, referred to the ordinary people who were being crucified on a cross of gold. It was a very vivid analogy that's kind of stuck in among the great campaign speeches of all time. Despite all that, the gold standard prevailed. Of course, there were exceptions. Countries went off of it temporarily, but generally prevailed as the monetary standard until the Great Depression, at which point every country went off of it and no country's ever gone back to it. And in the modern era, there's very few modern economists who would advocate it now. So I think there's a real kind of question here: why did it take so long? Given these analyses of key distinguished economists like Jevons and Marshall and Bixell and Fisher, why wasn't it abolished earlier? And one of the reasons we want to flag that is because we see a lot of parallels with the current constraint in our monetary system that arises from the effective lower bound on nominal interest rates. And that effective lower bound arises from a similar kind of historical coincidences, technical factors, idiosyncratic factors that weren't really very relevant for a long time. But starting in the 1990s, the Bank of Japan became constrained by the ELB. And then later in the 2000s, many other central banks, especially in the wake of the global financial crisis, the ELB became a serious constraint. And there's been a huge research literature. In fact, Gowdy was one of the pioneers in that literature and worked with Michael Woodford. Others at the BOJ, Tsutomu Watanabe did pioneering research in the early 2000s. And many papers since then about how to mitigate the effective lower bound using some combination of monetary policy under commitment, like forward guidance, or balance sheet tools like quantitative easing. But we've been surprised looking through this literature. And again, people may know of papers that we should be aware of, but I would say at the moment, it's remarkable to me how little attention's been given by our profession to the possibility of eliminating the effect of a lower bound. Can we just get rid of it? And can we do that before we have a major crisis like a Great Depression? Can we learn the lessons from the gold standard? Okay, so what do we do in this paper? And again, it's a brand new paper. Literally, we just sent it to Todd about a week ago, if I recall. And it still needs to be polished further. So any comments people have, missing references we have, if they're typos or any other kinds of improvements, we really appreciate your comments and feedback. But there's three parts of the paper. The first part is historical analysis, where we're identifying the parallels between the gold standard and the ELB. And the gold standard, there's famous work, seminal work by a very Icon Green, where he referred to it as golden fetters. So we decided we'll call the ELB paper fetters to kind of emphasize that analogy, and that's in the title of our paper. So that's the first section. The second section is to formulate a new DSGE model that we can use to analyze the disparate effects of monetary policy at the ELB. And in order to do that, we need two key elements coming from two different strands of the literature. One is the bounded rationality that limits the effectiveness of forward guidance, so that the ELB is a real constraint, that you can't wave a magic wand and get rid of it. And the other is to have a model with heterogeneous agents, different types of households. In this case, we're going to have a model where there's asset holders, and then there are constrained households that basically just consume their current income. And then we can look at the effects of the disparate effects of monetary policy at the ELB, again, drawing on the analogy with the gold standard, where we know that there were very important distributional effects of the gold standard. We want to look at those kinds of effects of the ELB. And we believe this is novel, but again, if someone knows about work that's looked at this before, we really appreciate your letting us know about it. And then the final part of the paper, which is brief, but we think it's important, is that it's not just desirable to get rid of the ELB, we think it's actually feasible to do it. And in fact, there's an opportunity right now over these next several years, as many central banks are considering digital cash, central bank digital currencies, that we see an opportunity here to eliminate the effective lower bound, and that could be done without abolishing paper cash, nor imposing any fees or restrictions on ordinary households and small businesses. So I'll come to that at the end of this talk, but let's jump into the historical analysis. And I'll try to be brief, and then people can ask questions here. I think what you see on this slide is remarkable kind of historical things I didn't know until Mike Bordo alerted me to the fact that Isaac Newton, because I think of him as the apple falling from the tree, that he was also the master of the mint for a while in Britain, that he was really responsible for establishing gold as the de facto unit of account in Britain. Prior to that time, silver coins were kind of the unit of account for normal day-to-day transactions, and gold was mostly used for international trade. But because he made what seemed like a minor shift in the relative prices of gold and silver, that basically pushed silver out of circulation, and gold became the de facto unit of account. And 100 years later, the Parliament adopted that into law, so it became de jure, not just de facto. Similar kind of story in the United States. Originally, silver mostly circulated, but the southern states of the United States were powerful in the US Senate. And in the 1830s, they pushed for an adjustment to the gold-silver price ratio. So it didn't require Isaac Newton, just required some US senators. And gold became the de facto unit of account in the United States. And finally, 70 years later, more or less, the US Congress established that into law. In the 1870s, Germany unified. They adopted the gold standard. They defeated France in the Franco-Prussian War. A few years after that, France adopted the gold standard. And again, Mike is an expert on some of those details, so I'll leave the Q&A for him on that part. If you look at the origins of the ELB, you see similar kinds of sort of technical factors, historical coincidences, and so on. Of course, we know that corporate bonds and securities and treasury securities pay interest. So then you might wonder, well, how come paper cash never paid interest? And the answers are basically technical factors that in order to do day-to-day transactions, consumers and businesses want small denomination notes or even coins. And those coins and small notes pass hand to hand without any ledger entries. So unlike a corporate bond or a treasury security where the debtor knows who's the owner of that security. And oftentimes these paper bills would circulate over an extended period of time. There were exceptions for the Bank of England where in the beginning of the Bank of England, they had notes that just circulated in London and would come back to the bank in a few weeks. And those actually did pay interest for the first 3 years of the Bank of England, and then they discontinued it. There are other exceptions in the Civil War in the United States where there were paper bills issued where they tried to attach coupons. It didn't work very well. The main point to emphasize here is that the fact that paper cash was non-interest bearing didn't matter under the gold standard. And the reason for that is because paper notes were claims on gold, and gold had a real rate of return that was competitive with other assets. In particular, the real rate of return on gold was roughly similar to the growth rate of real GDP per capita. And since paper was a claim on that, paper cash was a claim on it, you didn't have to pay separate coupons necessarily on paper cash. Only at times when a country or the US Confederacy departed from the gold standard, of course, that became a separate issue, but under the gold standard, generally, there was no need for it. What became apparent in the modern era of fiat money is lack of interest on paper money is becoming a problem. First of all, it was a problem during high inflation, because then there was a big opportunity cost of holding paper cash. And more recently, as I said, the ELB has become a problem because that's been a downward constraint on the nominal interest rate. But again, the fact that we have an ELB is kind of a historical coincidence, much like the gold standard. Okay, the gold standard was a severe constraint on monetary policy. I already mentioned that Marshall and Vixell and others had emphasized long periods of deflation because the supply of gold wasn't keeping up with demand. So the real price of gold had to change. But even more importantly, the gold standard was a constraint on central banks acting as a lender of last resort. And that was really what led to the banking collapse in the early 1930s and to the Great Depression. And I just want to emphasize here that the consequences go beyond the economy and the financial system. There's an important book by Straumann, 2019, it's in our references, where he discusses what he called, I think the title is The Deluge, how the banking crisis in Germany was a key element in the collapse of the Weimar Republic and the Nazi takeover. Now, for me personally, just in full disclosure, my great-grandparents all perished in the Holocaust. And so for me personally, trying to make sure something like that never happens again, and at least that is never linked to any failure of central banks or the monetary system, just kind of a core motivation for me in working with Mike and Aranima on this paper. Okay, now there is a question, there's been some discussion, well, how severe of a constraint is the ELB? And I think the simple answer to that is to just look at practical experience over the last decade in Europe and in Japan, even in the United States. We had a very slow, sluggish recovery. It took more or less 10 years for employment in the job market in the United States to return to levels that were consistent with full employment. And inflation during that period was falling below the Fed's target, and similar kinds of issues in other economies. Finally, part of our history section here is the disparate effects of the gold standard and the disparate effects of the ELB. And this is not in the paper yet, but the new graphs that we've been putting together, just to show you here in the United States, the blue line shows you the prime age labor force participation rate. Now, this is workers 25 to 54 years old, so they're called prime age, prime working years. And what you see here is the labor market was very unsatisfactory in the United States in the wake of the Great Recession. From 2009 to 2013, the prime age labor force participation was dropping, flattened out, and finally started recovering during the second half of the decade. So very long, slow, painful recovery in the labor market. Meanwhile, because of lower for longer, you see the QE1, QE2, QE3. The first rate hike finally comes 7 years after the onset of the financial crisis. And during that period, asset prices are booming in the United States. The Wilshire 5000 goes from, which is a broad stock price index, goes from 8,000 to 32,000. So you can see here pretty obviously from this picture how the lower for longer works well for the asset holders and not so great for ordinary workers. This is another set of data from the Congressional Budget Office showing essentially the same thing with the income distribution. This is pre-tax income, so before taxes and transfers. And what you see here, this is not even showing the lowest quintile. The lowest quintile didn't improve at all over this period, but the middle quintiles are the blue, and that basically their income, average income, went from 72,000 more or less to around 80,000. So call it a 10% increase if you want. Meanwhile, the highest quintile, the top 20% of the income distribution, went from around 250,000 up to around 320,000. Okay, so huge increase in their income, which is mostly asset income reflecting the boom in stock prices and other asset prices during this period. Okay, so now I'm going to turn to the model analysis, and I'll try to be brief. There's a lot of details here. Arnim is really the expert on this, but we start with a benchmark model that was formulated by Fernandez Villaverde and Rubio Ramirez. It's actually in Dynair, so it's easy for us to start with it. Lots of basic features that are familiar to you. And the two things we add, as I mentioned before, one is that we add what are called hand-to-mouth agents. Literally, it's households that don't have any assets, who can't borrow, they don't have any savings, so they just consume their current labor income. And that's following a recent work of Bilby and co-authors. A whole bunch of papers actually they've written on this that are important. So we're really building on what they've done. And then the other piece is to add in myopia, which is a way of resolving the forward guidance puzzle, the bounded rationality that I referred to here. And we're taking the particular approach of Gebek's, his AER paper about a year ago. Arnim and I've also looked at other approaches here, but in this paper, we're following Gebek's. And we run simulations of that model where we have a persistent preference shock, and we're looking at two simple rules. One is a Taylor style rule, which you can think of roughly as something similar to optimal policy under discretion. And then we look at an alternative rule following Kiley and Roberts that's much closer to an optimal policy under commitment, where you have a promise in effect that you're willing to allow overshooting of the inflation rate above the target, as opposed to the Taylor rule where you kind of converge monotocally to the target. The Kiley-Roberts rule, you get the overshooting, and that can significantly improve the outcomes relative to the policy under discretion. Okay, so let me show you the simulations quickly. And again, there's details here, but just to give you a quick overview, this is a simulations under a moderate size shock where you don't hit the ELB. you can see the nominal interest rate drops to around 0.5% or 1% in that range. And where we're just trying to show you in some sense how this combined model, which is the blue line, compares to the benchmark Keynesian model, the model with the heterogeneous agents, and the model with myopia. And the simple answer is that the myopia makes a big difference. This is an important point that Gabex and others have made. McKay, Nakamura, Steinson, and Angelitos and Leon, there's a number of papers on this. The effects of outer rationality and financial market constraints. That you get smaller drops in inflation here, and you don't need as big of a response of the interest rate. But generally speaking, these aggregate implications are fairly similar across these four variants. Where you start to see some importance here, even for this moderate shock, is that in this combined model, there's a big difference in the consumption behavior of the asset holders compared to the constrained agents. And the reason for that is because the asset holders benefit right away from the lower real interest rates that push up the asset prices. And so their consumption recovers pretty fast. The constrained agents, they're hand them out. They're just consuming their current labor income. And so eventually they recover too, but it takes maybe twice as long. Okay, then we turn to a much larger shock where you do hit the ELB. In this case, it's around 3 to 4 years period where you're at the effective lower bound. And the green line here is the Taylor rule, and the pink is the Kiley-Roberts rule. And there's some slight adjustments here. So when I say Kiley-Roberts and Taylor, it's not the original Taylor rule. It's not the original Kiley-Roberts, but something similar to those. And as you can see, the Kiley-Roberts does in fact do significantly better. Inflation stays close to target. Consumption comes back a little bit quicker. And in fact, the liftoff from the zero bound happens faster under Kiley-Roberts because you get the faster recovery and faster inflation rate. You just have to be willing to tolerate some moderate overshooting of inflation, but Kiley-Roberts works great. Now, here's what happens to the individual agents within the model under the Taylor rule. And here it is under the Kiley-Roberts rule. Well, you're still seeing the same pattern, is that the asset holders benefit a lot more from the monetary policy. This experience is pretty painful for the hand-to-mouth constrained households. And that's because the labor market takes time to recover. They're not benefiting from the low real interest rates that push up the asset prices. Now, this is just an example here. We're planning to do more simulations with alternative parameters and variants and so forth. But just to give you an idea here that generally speaking, the ELB is a bigger problem for ordinary workers who don't have a lot of assets. It's not as much of a problem for the large asset holders, like we saw in the data. They get pretty quick benefits from the lower for longer policy. Now, I'm just anticipating here things that Todd may mention, but just to be upfront that we can see lots of room for improvement in our model, lots of issues that we know about that we haven't gotten to address yet or even look into because this is a novel model. Assumptions about lump sum transfers, assumptions about the labor market, assumptions about where's the myopia apply, and serious treatment of fiscal policy. Those are all things to look into in future work. Some of which might have to wait until future papers. It's probably have limits on how long we can make this one. Okay, the final question I promised to say is that we think it's feasible to get rid of the ELB using digital cash. And the principles I'm showing you here, design principles, are ones that Michael Bordo and I have already been talking about for 5 years. So I'm going to be very brief here just to say, we think it makes sense to have public-private partnerships. You can have digital cash wallets that are provided by financial institutions. It could be a bank or some other payment provider, but the funds in the wallet would be held in reserve at the central bank. So it's perfectly safe. There's a centralized ledger. You can make instant payments for free. It's efficient, it's secure and convenient. And because it's a public-private partnership, it'll protect the privacy of individual transactions. Unlike something where the central bank is directly doing that directly with the public, but also facilitate appropriate law enforcement as opposed to something that's completely decentralized where it can be anonymous and has a risk of money laundering and other sort of problems. We think that the digital cash should be legal tender, but we also feel strongly that consumers and businesses should remain free to use other types of payments, including paper cash. And paper cash may start disappearing quickly in the next few years, but people should be free to use it if they want. We think digital cash should bear the same rate of return as other risk-free assets. And monetary policy could start using the interest rate on digital cash as its primary monetary tool. Okay, so how do you get rid of the ELB? Well, there's two relatively simple elements of this. In fact, these two elements don't even need to be present during normal times. The central bank just has to be prepared to put these into place if there's severe financial distress or there's a severe adverse shock to the economy. Then these two fees would need to be implemented to get rid of the ELB. The first is there has to be fees on large balances of digital cash above some high threshold. And the reason for that is to make sure that asset holders don't sell off all their private assets and try to shift into digital cash. It creates a disincentive. We think it's a much better idea than just putting a strict limit or a quota that effectively would ration the digital cash. The amount of digital cash would be endogenous in the system, but by imposing these large balance fees would discourage asset holders from the fire sales. We see it as very analogous to a safe deposit box fee that banks already charge. The only difference here is they would only apply to very large amounts of digital cash. Ordinary households and small businesses wouldn't be affected by this. The other component is you need to apply a transfer fee for transfers between digital cash and paper cash. Again, only for large transfers above some threshold. So that this would be totally irrelevant for normal families and small businesses. But what it would really do is discourage big financial institutions or wealthy investors from shifting out of financial assets into paper cash. In that sense, it's like an ATM fee, except that instead of the current ATM fees, which apply to a $40 or €40 withdrawal from a machine, these cash transfer fees would only apply to huge transfers like $1 million or something. Okay, so conclusions. Again, the historical analysis, we think there's a clear message from the gold standard era that we should get rid of the ELB promptly. Let's not wait. We can't wait for another crisis where the ELB becomes a really severe constraint that really hurts the economy and potentially has severe political consequences. We just cannot allow that. Our model analysis emphasizes the disparities of the effects of the ELB, and we think that deserves more attention. Certainly more work needs to be done in this direction. And finally, the practical analysis just underscores the opportunity we have right now with digital cash to get rid of the ELB without imposing any new restrictions or fees on ordinary consumers or small businesses. So again, many thanks to Todd for discussing this on short notice, and we welcome comments from everyone else too. I'll stop there.
All right, thank you, Andy, for that presentation. It was excellent and perfectly on time. So without further ado, the floor is Todd's for 10 minutes. Thank you. Okay, Todd, you might be muted here. We don't hear you.
All right.
Todd? Todd, are you there?
maybe he's switching the microphone.
Oh, I see.
How about now?
Now,
Finally,
perfect.
okay. Believe it or not, we did test this, right before we went live, and it was working then. Okay, so apologies for that. So I was starting with a disclaimer that I'm not an expert in monetary history nor in DSG models with or without bounded rationality. But part of the fun of being a discussant is you have a lot more freedom than an author to make speculative comments that may or may not be correct, and I plan on taking full advantage of that freedom today. So this is an interesting paper. As you saw, it covers a lot of ground. So I would summarize the main arguments in the paper with these four broad statements. First, the physical attributes of the payments instrument, be it gold or be it paper money, can constrain monetary policy. And here there's the analogy between the period of the gold standard and the effective lower bound. Second, monetary policy has distributional effects. And that means these constraints on policy that come from the payments instruments may fall disproportionately on some groups. Third, efforts to ease monetary policy further at the effective lower bound, so unconventional policy, may exacerbate these distributional effects. And as a result, the effective lower bound might be more costly than you would otherwise think it is. And then finally, that a new regime based around central bank digital currency could eliminate the effective lower bound without eliminating paper currency. Okay, so the paper had these three parts. There's a part about historical parallels, there's a part about the model, and there's a part about CBDC. And so I'm going to organize my discussion the same way. So let me first start by making some comments about the historical parallels. So in the paper, a lot of the discussion of the distributional effects of the gold standard focuses on this period between the Civil War and 1900 in the US, the period of the so-called free silver movement, which is a period of deflation, at least perceptions that credit is tight and that this is benefiting creditors and unpopular with borrowers. So, if I were to think of the elements of a model that might capture my imperfect understanding of this period, my starting point would be something in the spirit of this old paper by Sargent and Wallace. This is the paper on the real bills doctrine versus the quantity theory, a different monetary history debate, but with important parallels. And you could update the model. They had an overlapping generations model. You can think of something in a new monetarist framework based on Lagos Right. There's some borrowers. Think of these as being the farmers. They need inputs to produce. Lenders have access to these resources, but the lenders may also want a payments instrument. So banks are going to intermediate. Banks lend funds to borrowers. The borrowers use those funds to buy the inputs from the lenders. The lenders hold the bank deposits. Maybe they use them to transact. And there's also this money in exogenous supply. Think of this maybe as being gold, and it's growing at some given rate, right, which is determined by gold discoveries. All right, so that's a real rough sketch, but hopefully from that you can see kind of roughly what would have to follow. Suppose we think about stationary equilibria in which both money and bank deposits have the same real return. All right, and that's effectively what Sargent and Wallace did. So then just think, if the exogenous growth rate of the money supply is low, that means the real return on money is going to be high in a stationary equilibrium. And that means that the deposit rate is going to be high. Banks face a high cost of funds. That's going to mean lending rates are high, so credit's tight. Is that good or bad? It depends on who you ask, right? It's good for the lenders and it's bad for the borrowers in this model. And if you change the monetary regime, maybe you bring in silver and so the money growth rate is higher, then it's just the reverse. The rate of return on money and deposits is lower. That's bad for lenders, but the rate of return on borrowing is lower, and that's good for borrowers. So the key point, the reason I wanted to talk about this framework is when I think about that period and when I think about a framework like this, it kind of says, well, monetary policy faces this fundamental distributional tension, right? And if you ask, should the U.S. have allowed free minting of silver? Well, I don't know. Doing so, seems like it would have helped borrowers, but it would have hurt lenders. And I don't know that there would have that people think there would have been clear, large macroeconomic gains, at least in the steady state. And I want to contrast that with the 1930s, where again, given my imperfect understanding of the history, but my impression is the issue is very different. that the main story in the 1930s is that there were large macro gains from abandoning the gold standard. It would increase inflation and loosen monetary conditions like before, but now it would reverse this debt deflation problem that had arisen. If done early enough, it could have avoided maybe a lot of bank failures and so on. Okay, and then thinking about that, so that seems like a different issue, and you'd want a different model to think about. Presumably, there were also distributional effects at work, right? Moving away from gold would help debtors, and I guess at least initially it's going to hurt creditors. But my understanding is that those are generally thought to be secondary. That is, the argument for leaving the gold standard in the 1930s was not the need to help debtors at the expense of creditors, but rather the need to promote an economic recovery, even if it hurts creditors in the short run. Okay. So with that in mind, question, which historical episode better corresponds to the current period? That is, do we think about the problems associated with the ELB as being that it alters interest rates or asset prices in a way that makes some people better off and others worse off? But maybe, in terms of its effect on total output, maybe it doesn't have a huge effect, once the unconventional policies are used. Or, conversely, do we think that it does have significant macroeconomic costs? And there are these distributional issues, but maybe the distributional issues, maybe they are, maybe they aren't secondary. So I thought the message of the paper could be clearer on this point. So again, in the paper, a lot of the focus is on the free silver era, which got me thinking about winners and losers for monetary policy. But then the title Golden Fetters I understood to be about the 1930s and the macro issues. So now, some quick comments on the model. First, thinking about heterogeneity, and this is going to be related to the comments I just made, what type of heterogeneity matters today? So again, in the 19th century period, I'm thinking of its borrowers versus lenders. And, and when we think about the poor farmers, but the poor farmers, I don't think of as being hand to mouth. It was important, I think, that they were borrowing to buy land, to buy equipment, to buy seeds, and therefore were in debt and were hurt by movements in interest rates. So the model has a different focus, right? It's savers versus hand to mouth, or owners of capital versus just workers. And I was wondering, as I was reading, to what extent is that choice for technical reasons? That is, it's a rich model, there's a lot going on. Hand-to-mouth consumers, at least they're easy in the sense that their decision problem's easy. Or to what extent is that really the relevant type of heterogeneity we'd ideally want to look at? Meaning that this issue is very different from at least how I think of the free silver era. It's not about borrowers and lenders. It's really about who holds assets and who doesn't. And therefore, the disparate effects are coming not from high versus low interest rates per se, but at least directly from the changes in asset prices. Second, so in the model, the presence of the effective lower bound clearly is going to lower welfare, and it's going to affect. Andy showed in the graphs it affects the distribution. So I'm kind of wondering, what are the relative sizes of these effects? So if we measure sort of the welfare loss due to the, so if we measure the welfare loss due to the effective lower bound on average in, say, consumption equivalent terms, and if we somehow measure the distributional effects, which of these is bigger? Or to put it differently, to what extent is the effect of removing the ELB largely distributional, or to what extent is it largely about the macro benefits with some distributional impacts? And then the answer to that question I would think of as telling us, taking at least the model's view of the effective lower bound, which of the two historical parallels I talked about are sort of the more appropriate or the closer comparison. Second comment just about intuition, and Andy touched on this some. The model's very rich, there's a lot going on, and I'd like to understand the underlying mechanisms better. So when we think, one clear pattern that comes out is the consumption of the hand-to-mouth consumers recovers more slowly following a negative shock. Is that all about asset prices? I mean, clearly that's part of it, or are there other things going on? I would just like to understand that better. Okay. Some comments on central bank digital currency. So, it's widely understood that the effective lower bound, we say ELB rather than ZLB because the effective lower bound is below zero. How low? I don't know, but certainly below zero. But short-term interest rates in the US have remained positive. Why? So, if we go back 10 years or so in the aftermath of the financial crisis, I think the answer was there are a variety of institutional factors that were important. Money market mutual funds can't effectively pay negative rates, and there was concern they would shut down. At least initially, at the time, treasury auctions couldn't accept negative bids. So I'll call your attention to this, this old New York Fed blog post, insightful post by a then New York Fed economist that talked about these points. So I don't know to what extent that's changed in the last 10 years, but I want to say at least it's not immediately clear. In the US, we have a zero lower bound, it seems, and it's not clear that that zero lower bound is actually related to paper currency. Perhaps the Fetters are not of paper, but they're institutional and regulatory. And if that's true, how would that fact affect the plan? How would the plan here address that issue? Okay, two more comments. One, is central bank digital currency necessary? So the paper proposes removing the paper fetters without removing paper money. And Andy talked through the idea, you set the interest rate on CBDC negative, and then you impose these fees on transfers to prevent people from essentially arbitraging that with paper money. But do we really need CBDC to do this, right? Why not just set the interest rate on excess reserve negative, and then bank deposit rates are negative, and then you have fees to move between bank deposits and paper money? So Agarwal and Kimball had proposals along these lines. So I just want to ask, what's different here? Can we remove the CBDC from this proposal, and would it be largely the same, or not? And if not, what would we lose? I understand there are other reasons you might want to have CBDC, and I agree with that. But what would we lose in terms of this narrow question, the ability to mitigate or remove the effective lower bound if we took CBDC out of the proposal? And last comment, the model is used to evaluate the effects of removing the effective lower bound. And then question, will the proposal here, which involves introducing CBDC and the scheme, will that lead to the same outcome? I think the answer is no, right? If people are using CBDC, presumably they're holding less of something else. What else? What is that something else? And how is the CBDC introduced? How is the central bank balance sheet going to change? Particularly given that the proposal here calls for CBDC to earn a market rate of interest, it's going to be attractive, right? It seems designed to lead to a different outcome than simply removing the effective lower bound. So how would it affect, for example, the hand-to-mouth consumers? So given the model, I think it's hard to say. So for analyzing the effect of introducing a new payment instrument like CBDC, well, it seems desirable for the model to have in it payment instruments. And there's a literature that's developed along these lines. To what extent could these effects be combined with your already quite complicated model? I don't know, but I think it might be worth thinking about. Okay, so I'll end here and look forward to the discussion.
All right, thank you very much, Todd, for that excellent discussion. Should we give Andy a couple of minutes to respond, and then we take questions from the floor?
Well, thank you, Todd. That was really amazing. I guess how deeply you understood the paper in just a few days, especially because even our graphs were still evolving as of last night. Arnie and I were preparing the ones that I showed you in the slides that we think might be a little easier to understand, but Todd got all the key points. So let me address 2 or 3 things that he raised. First of all, as you said, Todd, the model is already pretty complex. We thought at one point about incorporating a gold standard and trying to represent that era, and we just realized it was going to take us pretty far afield. And not only that, but there is a nice paper by Cristiano Vestagno that looks at the Great Depression. There's some other recent work. Arnie remembers who it was, but other people who've looked. Who is it, Arnie?
Eric Sims.
Yeah, Eric Sims, right, has a beautiful paper about the DSGE model of what would a gold standard look like if you put it into practice now. So we could think about it again. Maybe that would make sense for a separate paper. Likewise, we thought a lot about incorporating a banking system and payments and some of the other issues you mentioned, Todd, and we were just worried because DSG models can quickly become a black box. Even as it is, if I tell you that just combining myopia with the hand-to-mouth agents is not trivial. Arnie and I could probably write 3 or 4 papers about all the different things that arise in that situation, and where you put the myopia really matters too. Okay, so you did ask why does consumption for the handouts recover more slowly? I think that's an important question we actually understand well from the real business cycle literature. The asset holders own capital. That's the point, right? They own the capital in the model. And so early on, they can cut back on physical capital investment and use, essentially use that to smooth their consumption. Where the hand-to-mouth agents don't have that luxury. They don't own the assets. If their labor income goes down because they're working fewer hours, then they have to consume less. And so part of the consumption smoothing that you're seeing for the asset holders is definitely coming through that mechanism. But then that's amplified by the drop in real interest rates from the lower for longer policy. You raised a question about why has the US never gone below zero? And I just want to emphasize here, early on, in fact, there was a Bank of Finland conference in early 2009, and there's all the papers the Federal Reserve staff wrote at that period are now in the public domain. There was thought that maybe, money market funds would just disappear for a while and come back once the crisis was over. I worry that the extent to which the Federal Reserve has never gone below zero reflects a very strong influence of banks at the Fed. The commercial banks own the regional Federal Reserve banks. They literally own them. They appoint 2/3 of the directors. The banking system is very influential in the United States. And banks were worried about cutting rates below zero. And so that was the major reason it's never happened. So you said institutional regulatory maybe, but also probably political and institutional factors as well. And then the last question you raised was, do we need digital cash to get rid of the ELB? And I think we could brainstorm a little bit more if a central bank ruled out the possibility of adopting digital cash for other reasons. It would be great to think hard about, are there other ways to get rid of the ELB? I think our point in this paper is, for many central banks that are seriously considering the design of digital cash right now anyway, is to take advantage of this opportunity to get rid of the ELB. We think the motivation for doing that is critical. We want to make sure there's never another Great Depression that caused by monetary constraints. And now is the chance in these next few years to make sure something like that never happens. There could be another Great Depression for other reasons, but let's make sure it doesn't happen because of an arbitrary constraint from the monetary system.
Yeah. Can I jump in? Hello. Sure. Yeah. Okay. Just a history question. Todd, you're right. I mean, there is a difference between the 1890s and the 1930s, and you're right. It's the 1890s. It's a distributional issue, and in the 1930s, primarily macro. So, and we used, in a sense, that the golden fetters analogy is from the 30s, and it is a constraint. So that's why we had both of those things. But you're right. It's really a distribution story, and that's why we emphasize that.
All right, thank you. So we have one question from the panel side, Rafael.
Hey, thanks very much for this great presentation and discussion. I just coming really with a policy hat on. I sit in all the various work groups. We collect data on where central banks are going, and sort of actually there the trend is really it goes more in the other direction. That sort of 2 years ago, we were discussing possibilities for monetary policy, and that has come really less and less into focus, whereas really sort of the microeconomic advantages of maybe having a better handle on the market structure of the payment system, how to sort of frame privacy frameworks in a payment system. And these considerations have come much more to the fore, and the central banks have sort of agreed on certain principles, and actually the Riksbank is part of that discussion, where as part of sort of the notion to do no harm, there is an adamant emphasis on sort of that cash will not be phased out, and that the systemic implications would tend to be limited. So, and obviously, right, but with these measures, then you will, as a corollary, also have very limited effects on the effective lower bound. Now, I just wanted to know, sort of, if you think about sort of where central banks are coming, and that is sort of the political economy, how could you mitigate, sort of, if you still say, no, we want to sort of maximize the sort of the margins, so the effect of the margins we have in mind, but on the end, sort of, we know what's sort of politically feasible. What would be sort of the measures the central bank could achieve that?
Well, I think that, but I mean, as Michael Bordo and I have been giving our presentations on digital cash over 5 years, we've gotten lots of feedback. One part of that definitely was the extent to which many central banks have been approaching payments for many, many years as essentially microeconomic issue, and that it's urgent actually to talk, for having more conversations between the monetary department, the monetary policy department, and the payments department. I think it's also urgent to design digital payments that don't create new restrictions and new fees and new burdens on normal consumers and small businesses. I feel strongly about that, and I think the design we put forward in this paper, satisfies that objective. I think it's critical that we have a monetary system that works well for everyone. And I think the problem, I showed it to you as clearly as I could over the last decade, is that people at the top end of the income brackets were doing really well during most of that decade. But when you talk to ordinary families in the United States, they didn't think so. And you can see why, because they're not exactly hand to mouth, but there's a lot of American families that didn't have a lot of savings, that didn't own, significant bundles of assets. And for them, it was a very, very long, painful, slow recovery. And I think a question here is, if we could get rid of the ELB, maybe monetary policy would be able to promote a more, more rapid economic recoveries, and the political benefits of that would be very significant.
Okay, so we have Antoine.
Yeah, so I think my question is somewhat along the line of what Raphael asked. So your paper relies a lot on sort of historical analogies. And one thing you could look at is there are a bunch of countries that have gone slightly negative and see how they like it. And so I had in mind a paper by Jean-Pierre Dantine, who was an academic and was on the governing board of the Swiss National Bank. And he made a point that he doesn't think deeply negative rates are politically feasible. And in Switzerland, negative rates are incredibly unpopular. So I don't know if it sounds a little bit like your story would have to be, well, if we go negative a little bit, people will hate it, but then if we go negative a lot, people will love it. And I find that it's an interesting argument. So I'd love to hear how you think of it.
Actually, you know what, Antoine, I apologize, because I can see now that the presentation didn't cover this. We really need one more slide. And probably we can expand the discussion in the paper too. So let me try to be very precise here. We don't think that you need negative rates for 90% of the population. Okay, for all ordinary households and almost all small businesses that have bank accounts with $1,000 or a couple $1,000 or a few $1,000s, or a small business that has a $50,000 bank account, you can just put a lower bound of 0 on all of those. And in fact, that is essentially what the ECB and the Bank of Japan and some other central banks have done for practical purposes. They've tried to insulate ordinary families and small businesses. The reason for having negative rates is risk-free assets like treasury securities and AAA corporate securities need to be able to drop in nominal terms well below 0. And the reason for that is because you want the risky rates, when there's a spread between the risk-free rate and the risky rates. When that spread widens, you want to keep the risky rates from going way up. And the way to do that is to allow the risk-free nominal rate to go well below zero. The only people who care about that are the asset holders who own millions of billions of dollars in assets. Okay, and you want to drive their risk-free returns below zero, so they're continuing to be willing to hold the commercial paper and the corporate securities and other kinds of things at moderate positive rates. Then you have a much quicker, smoother recovery of the financial system and the real economy. So I totally hear you. We're not calling for steep negative rates. In fact, maybe not for negative rates at all for most of the population. But the central bank should have the ability to cut rates further below zero on that margin. And what I understand from reading papers, Gaudi Ergetson's written some of them, is that even in Europe, even in the Swiss National Bank, and certainly in Japan, the fact that there's a lot of paper cash is what creates the frictions as some of these rates are going below zero, starts to mitigate even the benefits of cutting rates further. And that's why central banks haven't gone any further than they did.
Okay, so we have 3 more questions. So please try to be brief. Russell.
Yeah, but maybe Boy can ask first, so I move myself in the end of the line. So please go ahead.
Okay. Yeah. Björn. You're muted. Now the sound works.
Okay,
yeah, now it works.
Just a short observation here, and just in line with what Andy said, that Sweden had negative interest rates for about 5 years, and we could see that they were not passed on to households, but only to bigger companies, etc. So that was a market decision by banks, I would say, and that was also without the CBDC. That's all. Thank you.
Thank you. Dirk.
Yes, hey, thank you very much. Just to make sure I understood, Andy, did you suggest that the interest rate on CBDC should be equal to the risk-free rate or equal to something like a deposit rate in the current system? And the second, and why? Probably some Friedman type argument that you have in mind, or is there some other story that you have in mind? And the second thing is, I'm also a bit confused about these kind of market segmentation, like the ECB suggests we could possibly implement, and that you obviously you also seem to have in mind that some people pay a certain interest rate or receive, and the others have a different, and some people have fees and some others don't have fees. If you think about this in the international context, exchanging one CBDC into another CBDC, from one currency into another, the marginal investor who would be exposed to some interest parity conditions, these would be the guys, I suppose, with a high volume, and therefore the ones subject to the negative interest rate, presumably, and subject to fees or subject to no fees. Could you clarify that, please? Thank you.
Okay, great. I mean, this is great, Dirk. I hope you and I can talk offline sometime, because you're asking deep questions. Just briefly, I think that the fees that we're talking about may be totally unnecessary during normal times, that everything could just be instant and free. Okay, the logic of these fees is that in the middle of a financial crisis, you want to make sure that people don't have a fire sale and try to shift all their assets into digital cash. And that's why you'd like to push interest rates below zero. And so instead of, it may be possible to do this like with the safe deposit box fee. That's the analogy that we've come up with here. That during a financial emergency, asset holders can move into digital cash if they want. There's no quota, which some people have suggested. We think that would be a mistake. What we think is better is a pricing mechanism where the central bank can discourage fire sales by imposing a larger safe deposit box fee. And there's externalities to doing that. So there's a very strong public motive for it. Again, a lot more analysis is to be done on this. This is just kernels of ideas. I think that the reason for the transfer fee is to discourage people from withdrawing out of digital securities into paper cash. So my instant answer, which could be mistaken, but my instant answer is, you don't necessarily need any fees for moving from one, say from a euro, digital euro to a digital dollar or a digital Swiss franc or a digital e-krona. Okay, those could all be free and instant all the time, even in the middle of a financial crisis, even in the middle of a significant downturn, so that all the benefits of the free international transactions that we much more secure and efficient in a digital currency world. Okay, the only fees we're recommending here is if you want to take your money out of the digital system and put it into paper cash. And if you want to, again, we're not going to prohibit people from holding paper cash. We're just trying to discourage a huge financial institution from building a warehouse in the Swiss Alps and and storing billions or trillions of paper bills there.
All right, Russell.
Yeah, I'm thinking of who are really constrained by the ELB. So maybe Todd mentioned some of it. So there's a paper by Eric Ranson saying, okay, if we look at the Fed, so we are not that much constrained. So it's one view. So and another view is we talk about, okay, the bank may be constrained by the zero deposit rate. It is true, but we also see in the core report data, the fee income of the bank increased a lot. So although they cannot avoid zero lower bound on deposit rate, but they can charge fee income. So that's another way to go around it. So that make me wonder how relevant it is. But since we have a HAG model, heterogeneous agent model, one reason people talk about the CBDC is now the central bank can trade directly through the open market operation to people. So maybe they can trade directly with the hand-to-mouth model and inject liquidity directly into their own pocket. And maybe there is another first-order consequence of doing CBDC. So with cash, the central bank cannot do it. But since now there may be everyone have an account at the Fed, realize the CBDC, it may become feasible. I'm just wonder, what do you think maybe that might be doable in the model and may have some bigger consequences?
Okay, so remember, we're advocating a public-private partnership here. We're not advocating the central bank to start opening accounts directly with the public. But even under this public-private partnership, if you have a low-income person who's receiving unemployment insurance or other benefits, they can register their digital cash wallet with the Treasury Department or the Commerce Department, whoever's paying those benefits, or even the state unemployment office, and then those payments get deposited directly into their digital cash wallet. Okay, might be much more efficient. The problem we had last year during the pandemic was the government was sending out benefits to people in paper checks that took weeks to deliver. And if someone had moved or was even just staying with friends or relatives, then there's an additional delay before they finally get it. And then they have to find someone who was willing to cash the paper check. And so it really was difficult for a lot of families that were in need at that time and small businesses. So we think setting up this kind of public-private partnership with digital cash wallets would help, but it's probably beyond the scope of the model. The other thing I just want to emphasize here is Eric Swanson, an esteemed colleague of mine, and I worked together literally offices next door to each other for many years at the Fed. But if you look back at Eric's analysis, he's looking at the extent to which some Fed forward guidance announcements move policy rates by 5 basis points. The Fed's conclusion from that was, well, we can just make bigger announcements. We can do bigger QE. And that may be true, but the fact of the matter is, when we look at what happened over this last decade, it was a very, very long, slow recovery of the job market and a long period of shortfalls of inflation. So it certainly looks like the Fed was constrained. And likewise for the ECB, likewise for the Bank of Japan, persistent shortfalls of inflation from their target, even though they were trying to use other tools as actively as possible. So this idea that the ELB is not a real constraint. I have trouble getting it, but again, Russell, maybe you and I could talk offline and you can help me see it more clearly. I really appreciate your feedback.
All right, thank you. So we have 5 minutes overdue, but before we close, I want to offer the floor to Michael or Arunima if you have anything you want to add.
So, okay. Yeah, these are really great comments. We can deal with these historical issues, okay? Because I think, as I said earlier, I think that both aspects of gold and fetters are relevant. Okay, both the macro effect of the Great Depression, because as Andy says, we don't want that again, and the distribution effects. So I think that we can do that going forward. And the other comment is about negative rates. And I give this paper all over the place and I get the same comment all the time. I also get the comment about privacy, but I think I agree with Andy on the case for CBDC, that it can be welfare improving, not just in the sense we're talking about here, but it can make it's an efficiency argument, and it's a transformation that we've seen, these kinds of transformations we've seen before in history. The origins of banknotes and central banks, okay, paper money, these were major transformations that had social savings, and that's how we see a CBDC. Thanks.
Thank you for the comments, and Todd, that was a really excellent discussion. So I just wanted to circle back to Russell's point about who the ELB matters for. There is work, Jordi Gali has work that talks about the relevance of the ELB and so on. I think what we are trying to focus on here is a persistent ELB episode and how that's going to have distributional effects across these two types of agents, or other types of agents, and that we think is some that has been perhaps not been focused on as much in the literature. But your points about how would these be getting and helping the hand-to-mouths and so on are very well taken. So thank you.
Okay, so with that, we thank the speaker as well as the discussant for excellent contributions, and we end the session. Thank you.
Yeah, thank you again to Andy, Todd, and David, and all of you, right, for the presentation and thought-provoking discussions. We hope you will be able to join us again next month when the FIDIFED will host our next session. So next time we'll have Marcus Bunemeyer talking about platforms and tokens. Charlie Can will discuss, and Daniel Sanchez will moderate the session. So until then, I hope you have a pleasant day and a nice weekend. Bye.
So I will go offline right now and stop. Yeah.